Let's now turn to a broader look at the markets following the cool down in U.S. inflation. We've got Zachary Griffiths, CreditSights senior strategist. Zach, looking at the market reaction today, it certainly feels like investors are seeing this as potentially the top in inflation. How do you look at the numbers we got today?
Akiko, definitely some encouraging numbers as far as a disinflationary backdrop. And of course, we're not seeing deflation at this point, but prices starting to come down at a faster pace than most were expecting. So we think it's very encouraging. And when you think about the market reaction, it really comes down to terminal rate pricing by the Fed. People are now expecting the Fed to tighten the policy rate less. That is resulting in a considerable risk on rally, which makes sense to us. We think that things had gotten too pessimistic, pricing in a much higher terminal rate, and then had been weighing on risk sentiment. So today's data was definitely an encouraging sign. There's still plenty of work to do, but the market reaction so far makes sense to us.
Yeah, I mean, with that said, it's sort of been sort of a back and forth, right? When you look at where the market reaction has been on some of this economic data, on the one hand, you hear from Fed Chair Powell, who's saying that, well, look, maybe we're not going to increase at the rapid rate we've been doing, but rates will stay higher for longer. And yet you get something like this, and immediately it sort of brings it back to, is there a potential slowing in the rate hike? Could there be a pivot down the line? Does your fundamental case on how the Fed is tightening, does that change at all based on today's data?
So today's data actually affirms our view that the Fed will hike 50 basis points in December, and we had been anticipating a terminal rate of 4.25% to 4.5%, which the Fed would hit if they deliver that 50 basis point rate hike. So I'd say the risk to our call is probably still to the upside. We're below where the September dot plot would have indicated the terminal rate, but we think that when you think about the changes to the policy statement that the FOMC made at the November meeting, it emphasized the long lags between changes in monetary policy and the economy and inflation, as well as an emphasis on the cumulative amount of tightening they've done so far. So we think that's really queuing up the Fed to slow the pace of rate hikes and perhaps even pause as soon as the December meeting, if not in early next year. And that's a welcome development for risk assets, certainly today, and is more consistent with our view that we've been holding on to, although things have been moving kind of against us over the past couple of months.
In terms of the price pressures that we are seeing, Brooke kind of breaking down where food prices are. We saw core CPI up about 0.6%. What about some of the key areas that we've been watching really closely, particularly rental inflation, housing inflation? I mean, to what extent are we starting to see a cool down there? And what does that trajectory look like for you?
So we did see a bit of a cool down, especially on the rent of primary residence and OER side. Now they're still at historically elevated levels at around 0.7 or 0.6% month over month, but definitely encouraging to see at least a halt in the increase in the pace of those rises. And when we think about where the housing market is today, you're starting to see the housing market cool substantially as mortgage rates have risen. Now that takes some time to filter through to the official shelter cost measure in CPI. So when we think about how the Fed considers policy and how the impact of its policy tightening so far is affecting the economy, we think they'll take into account the lags between the changes in the housing market dynamics we have now and how it impacts prices. So we did see a step in the right direction today. There's still plenty to go, but we do think there's more of a disinflationary pressure in the pipeline driven by the tightening of mortgage rates.
Final question, Zach, on strategy here. I mean, it's sort of been a bit of a schizophrenic week. We saw a rally going into the midterms. We saw a big sell-off yesterday because of the uncertainty around the control of Congress. And here we are seeing a big rally yet again. From a strategy standpoint, what are you advising your clients in this choppy environment? What do they do?
So we think the big takeaway from this week comes from the CPI print and the more encouraging results there. And from a midterm results election, I think that the red wave really did not materialize, but the divided government that seems all but clear from here is generally a positive for risk assets, as we're not going to have any sweeping legislation over the next 2 years. So it affirms our view from a credit perspective that we think spreads can tighten in a bit through year end, and we are more constructive going into the first half of next year, as we think that as long as the Fed doesn't over tighten, the U.S. economy can avoid a recession and just grow at a below potential 0 to 1% run rate this year. So we are constructive on credit, especially investment grade, and that's what we're advising our clients right now.
Good takeaways there. Zachary Griffiths, CreditSights senior strategist. Appreciate your time today.